Okay, we are back with Alexander Macdonald. He's portfolio manager at Davis Ray. He talked in broad strokes about the tech sector in 2025. We'll now get to some specific stocks. One you like is Alphabet, the parent of Google.
Yeah, so I mentioned that a little bit just before the break. We like it really, its valuation, 22 times earnings. I mean, you can't get anything quite that cheap on an earnings basis among any of the Magnificent Seven. As well, very strong in the AI space. Maybe not the leader, but does certainly have products that are widely used. And then great diversification away from that. I mean, it's the leader of search, strong advertising business, YouTube, Waymo. I mean, we think Alphabet's a really strong company. In addition, something I didn't mention, though, very strong generator of free cash flow. More recently, a lot of that free cash flow has been invested into generating some of these large language models. So if we do see the AI hype, the AI narrative sort of die off in the next year or so, Google can ramp down those investments and direct potentially more of that money either to other investments or to return it to shareholders.
You also like Apple, and this is interesting because Apple is not as loved as it used to be. It's got its detractors now. A lot of people believe that iPhone sales have more or less plateaued. There's the stock. It's done well. It did very well in 2024. Why do you like Apple?
Yeah, Apple a little bit more expensive than Google. It's at 34 times earnings. It has not been as loved because it's not spending as much of that CapEx on AI as sort of some of the Googles and the Microsofts has been. It's been seen as a bit of a laggard when it comes to the AI space, in addition to the issues with potentially plateauing iPhone sales. But you are starting to see it roll out some AI tools into its new iPhones. I mean, I think there's been 2 separate product rollouts so far. Still in the early days, but it is active in that space, taking it seems to be more of a wait-and-see approach to what it's going to do there. But we do like Apple because of its huge existing installed base of these iPhones and what that means to potential upsales on the services side. Mm-hmm. So when you look at its gross margins for products, it's about 44%. But with the services side, that's upwards of 70% gross margins. So no other company in the world, I don't think, has an installed base like Apple with consumers where it can potentially feed more services and sell more services to its consumers. So that's why we think the valuation is justified here.
Okay, Microsoft is another one that you like. It's trading at about 33 times expected earnings.
Yeah, so Microsoft, I think, could be seen of the big tech companies as one of the leaders with the large language models in the AI space. Of course, it has the open AI investments that everybody's been familiar with ChatGPT. So very strong operations on that side. But like Google, very well diversified away from the generative AI space. So it has productivity software in terms of the Office suite, a huge cloud business that Google has as well, too. And that's been growing very well in recent years and a huge cash flow generator for it. And then a personal computing business that's very strong as well, too, with its Surface laptops and, of course, the Windows operating system that it sells. So, again, like Google, been investing a lot into generative AI. If potentially that falls off, it can dial back that CapEx, and it has tons of free cash flow that it can deploy either to other investments or to return to shareholders.
Okay. You are not a buyer of Nvidia at these levels.
Yeah, so Nvidia, again, on a headline basis, trading at 33 times earnings, so in line with what we saw, what I talked about with Apple and Microsoft. But when you dig into the E in the PE ratio, the earnings, what's driving that, it's significantly different from what we're seeing from an Apple or what we're seeing from a Microsoft. A lot of Nvidia's growth that we've seen over the past couple of years has been only from the generative AI space. Of course, it makes the high-end GPUs, the processors that are used to power these models as they're doing the learning. There's been so much demand for these processors that Nvidia simply can't build them quick enough for how they're being sold. But outside of that, there's not a huge diversified earnings base. So if that gold rush, if the AI boom does start to slow, I think Nvidia is going to be impacted disproportionately on the downside. That said, of course, if it continues, this goes both ways. So potentially could trade up.
Tesla is always an interesting story. It's a maker of electric vehicles, obviously. It's a tech company. It's pursuing autonomous driving. And Elon Musk is a regular companion, it seems now, of the incoming president of the United States. And you're cautious on this one, too.
Yeah, I mean, Tesla's been generating a ton of headlines again recently. I'm not sure what it is. Is it a car company? Is it autonomous driving? Is it AI? Is it Elon Musk that you're buying here? It trades at 137 times forward earnings, which is astronomical. Even if you think it could expand margins down the line and that multiple's inflated, it's still trading at 11 times sales. So none of these multiples make sense, certainly for a car company. If you look at GM or Ford, they're trading at 5 times earnings. There's been a lot of hype over the robo-taxis. It had an event recently where it even hyped up that it was going to build straight-up robots. I think the robotaxi technology, it always seems like, or autonomous driving, always seems like it's 10 years away. It's easier to do where it's happening now, sort of in the southwestern United States, where it's warm, you don't get snow, the weather is always good. You can geofence them so they don't have to travel outside a very well-known boundary of where they're going to operate. So I think widespread adoption of robotaxis or autonomous driving is very, very far away. I don't think Tesla should be trading on any sort of near-term earnings from that. And then the electric vehicle, the uptake we've seen from that side of their business recently has slowed pretty considerably. And there's competition coming in from other auto manufacturers as well, too. They're not just standing around, they're going to build their own electric vehicles. So the multiple on Tesla seems just astronomically high to dip a toe into. And I'm not entirely sure what's going to drive their earnings going forward. So that's one we would choose to avoid.
Okay, the three you like that you've talked about, Alphabet, Apple, and Microsoft. What's your advice to investors who want to establish positions there? Wait for pullbacks, edge in? How do they do it?
Yeah, I mean, so of the three, I think Google right now, we personally would be buying the position. The other two, because the valuation's a little more elevated, we would consider those more of a hold. I don't think we'd increase our weightings in our portfolio right now, but that's sort of how I'd rank them. Google, I think, is the most attractive valuation now. Apple, Microsoft were sort of like 1B and 1C in terms of adding to portfolios here.
Alex, thanks a lot for joining us today.
Thanks very much, Paul.
It's Alexander Macdonald. He's a portfolio manager.